Good evening, everyone. Yes, can you hear me? Please, can someone hear me?
Yes, I
Yes,
can
we
hear
can
you.
hear you.
Thank you. All right. All right, thank you. All right, so I hope you're all doing well, please. Eh, Please, I hope you're all doing well.
Yes, seeing you.
All right, I'm also fine, thank you. So, yeah, so I might not be okay. We are going to do this stuff again in the normal class, but I might not be getting time to solve maybe some of the past questions. So I've decided to maybe solve them maybe sometimes on my own, and I will just upload it so that maybe if we are done with those topics, we will just come back and watch them. Or if we have the chance to solve them during normal class, so that will be fine. So I'll be starting with management accounting today, question number one, which is always about the performance uh, evaluation or measurements. Okay, let me record. Let me see. Okay, so I will be starting with. Okay, so I'll be starting with question number one. Okay, question number one, which is always about what we call performance, performance evaluation or measurements. Okay, so we will be looking at that very shortly. So if you talk about performance evaluation, you see, as a management accountant, you are not going to be taking control of your own organization. You are not going to be in charge of financials of your own organization. You are going to be employed by people, and you are going to be having bosses. You are going to be having the management or the directors and those people there, and you're also going to be one of the employees. So we are going to be having the directors who are going to be in charge of what the operations of the entity, and you are going to be a management accountant there, telling them the kind of project that they should undertake, how they should be able to achieve their targets and do stuff. Okay. And the company that you are going to be a management accountant for, or the company that we are going to be having uh, management or directors over there are not going to be company owned by those people. They are going to be company owned by people that the people do not have the time to manage their own organization. So they are going to be appointing people to manage the organizations on their behalf. So at the end of the day, you should be able to generate a return on the investment that the owners are making. So at the end of the day, the owners will want to know, will want to find out whether the management is making a good return on their what on their investment. So they are trying to assess whether management is making a good use of their resources or they are not making a good use of those resources. So how do we measure or how do we determine whether management is making a good use of the resources of the owners? We try to do what we call the performance what evaluation performance measurement. So we can actually assess the performance of the management using the normal ratio analysis. So we try to express certain figures in the financial statements as a proportion of the other one and compare with what prior year performance or compare with performance of what similar or what industry or similar organizations. Okay, so we also look at what we call the return on investment. So we look at the ROI. We use the return on investment. So what is the money that we are bringing? And what is the profit that they are making in that particular one? So if I'm giving you 20,000 Ghana cedis as the capital, this is the capital that we are bringing. This capital can be from the owners. Okay, this 20,000 can be from the owners. We know that the owners can bring, like, let's say 15,000, and maybe outsiders can also bring, maybe, which we call the liability, maybe loan or something, which is going to be the non-current liability. They can bring 5,000. Okay, all these all these sources, they are bringing the money for what? For a return. Owners are bringing the money for a return, which will be in the form of dividends. Loan holders are bringing the money for interest, which is also going to be a return. Okay, so if these two sources, they are bringing 20,000, how much am I generating on it? Let's say at the end of the day, I'm generating a profit of 20,000, which is before tax and before interest, profit of 2,000. I'm using 20,000 to generate 2,000. So what proportion of the 20,000 will give me 2,000? So if I'm sharing 20,000 into 100 equal parts, which part will give me 2,000? So you just do your return on investment. You be the profit. This is just like return on capital employed. So net profit before interest and tax over the capital employed, which is 20,000. Then you have your multiplier by 100. Then you have what we call 10% over here. So for every money that the people are bringing, you are giving the 10% of that money as a return, which we call a return on capital employed. We also have what we call the residual income. Okay, the residual income is also a very simple idea. Okay, so the people are bringing 20,000. Okay, assuming the owners are going to be investing the money into a separate security without investing into the company, how much should have been given to them as a return? So assuming the 15,000 that I have, I don't want to put it into the business. Okay, I want to invest it into treasury bill. How much will I be getting as a return at the end of every year? Let's say they will be getting 10%. Okay, the loan holders also, if they want to use their money or they want to give the loan to different companies, they also be charging 10%. Okay, they also be charging 10%. So it means that the owners, if they should not invest the money into the business, they would have invested the money somewhere and get 10% return on it. The loan holders to other bank, assuming they have not given the 5,000 to us, they would have given that 5,000 to somebody which they would charge interest of what, 10% a year. Now they are giving this money to us now. It means that the owners are going to be expecting us to give them 10% on the money that they are bringing. So 10% of 15,000, that will give us 1,005. Okay. And the loan holders are also going to be expecting us to give them 10% on the 5,000. That will give us 500. Okay. So in total, we are going to be paying these people 2,000, which is indirectly as 0.1 multiplied by the 20,000 capital that they are bringing. So we are going to be giving them 20,000. So since we are using this money to make profit or to run the business, if we are able to make a profit of 5,000, if we are able to make a profit of 5,000, okay, if we are able to make a profit for the year of 5,000, okay, this profit of 5,000 is going to be profit before interest and whatever. Okay, so out of these profits, we have used the 20,000 to make a profit of 5,000. We are using 15,000 from the owners and 5,000 from the loan holders. Assuming these people have not given us this money, this profit of 5,000 should have been made. But since they are giving the money to us, they are expecting us to give them 10% on the money given to them. So it means that since we are using the 20,000 that they should have invested somewhere, we are using it. It means that we have to pay them the 1,005 and then the 500 on the profit that we are making. So we come here and call something imputed interest. This is just an assumption that if we are to pay the return on investment, it would have been 0.1 cost of capital multiplied by the total money that we are using. So this will give us 2,000. So we subtract the 2,000 from this one and have 3,000. So this 3,000 is what we call a residual income. The assumption is very simple. Assuming the money that you are using to make the profits, assuming the money was not given to you, the money would have been invested somewhere, which would have given those people interest. But since you are using the money to make profit, you have to now pay them interest or pay them a return out of that profit. So we calculate the interest that should have been paid. What is the amount that we are using? What is the cost of capital that should, or what is the return that should have been paid to them, assuming they have not given us the money? That is the money that should have been paid, 10% of the money that we are using. But since they have given us the money now, it means that we have to pay them the 10% out of our profits. So if you pay the 10% out of the profits, how much would have been left? That's what we call the residual income. Okay. So we also have what we call the economic value. This one we look at them we look at them into details when we are doing other stuff. So we have what we call the economic value added. Okay, the economic value added works like the residual income, but just the economic value added, we use economic profits, which we use cash profits. Let me just say cash profit. We use cash profits, but the residual income we use accounting profits. What it means is that we subtract depreciation, we subtract bad debts from the profit before we determine our final profit and use. But for economic value added, we want to know the actual cash that the people are generating in excess. You can see that they're supposed to give us 2,000 on the money, but they have made a profit of 5,000. So it means that they are generating additional 3,000. But this 3,000 is not cash because it's profit. Okay, it might be having some uh, profit from disposal of assets, which is not cash. It's just a profit. Okay, so they consider they are generating additional 3,000 on the money that the owners are bringing or the farm providers are bringing. But this 3,000 is not a cash, but we want to know the extra cash that they are bringing. So we now change the profit now to cash profit, which we call the economic profit. So we do adjustments, depreciation, bad debts, and other stuff will be subtracted before getting this profit. So we add it back to know our cash profit and other stuff, and we get that one. Then we also look at what we call transfer pricing. The question that we are going to be solving is something about transfer pricing. Okay, so what is transfer pricing? This is where we are going to be. Transfer pricing is very simple. Okay, we have certain organizations that they are going to be having a group and you have subdivisions. Okay, so I can have assurance group of companies here. So for example, I can have the assurance group over here. The assurance group, we can have so many divisions or subsidiaries under it. So I can have like maybe if I'm producing pure water, I can have assurance ice here. Okay, this is a subsidiary. I can have assurance professional school. Okay, I can have maybe assurance grade academy or excellent grade academy. Okay, excellent grade academy or something for basic school or something. Then I can also have maybe I can also have a company that will be producing textbooks and so I can have assurance stationery or something. Okay, so you can see that uh the assurance stationery will be producing books, but assurance professionals will be using some of those books, and the assurance excellent grade academy will also be using some of those books. Okay, I cannot have a division. Assurance group cannot have a division or a subsidiary that will be producing books, but excellent grade academy and assurance professionals could be buying the books from outside. No. When assurance professional school and the excellent grade academy, they are buying the books from outside, they are going to be incurring distribution costs and other costs. But if they should be buying from assurance stationery, we can be able to save maybe the distribution cost or the transportation cost, which is going to be increasing the profits for the group as a whole. So it's very simple. One of the subsidiaries is producing books, and one of the subsidiaries is also using books for its particular or for its services or for its production. We cannot allow one of the subsidiaries to be selling that raw material to outsiders, and one of the subsidiaries will also be buying the same raw material from outsiders. No, it is going to cost us a lot. Okay, so what we do is that we can say that, okay, the books that you are going to be producing here, since Assurance Professional School or Excellent Grade Academy will be using those books for their activities, don't sell all the books outside. Make sure that you are able to supply the Assurance Professional School and Excellent Grade Academy the demand for the books before you sell the remaining to us. to outsiders. Okay. Now, what would be the price at which assurance books will be selling their books to Assurance Professional School and Excellence Grade Academy? That price that the books will be transported or the goods will be transferred internally. The price at which the goods will be transferred internally. That's what we call the transfer pricing. So if you have, let's say we have the Casabreku and the other stuff here. Let me just use Casabreku here. Okay. Let's say Casabreku is having division A and division B. Okay. Division A is producing flour. Okay. So the flour is what we are going to be using to produce bread. And this is also producing, division B is producing bread. Okay, division B will be needing the flour to produce the bread. Okay, we cannot allow division A to sell the flour to outsiders, and we allow division B also to go and buy the bread from outsiders. We can only allow that when the price at which division B will be buying from outsider is lower than the price at which division A will be transferring to them. So in that case, we are going to be saving cost. But if the situation is otherwise, we cannot allow that, because if you are buying from outsider, you might be incurring distribution costs. Okay. But if these two divisions are the same side, they are the same place, it means that if we are selling to B, there will not be any distribution cost. So we are saving a cost. So we will not say, okay, what will happen is that don't sell, we can tell division A that don't sell any of your flour to outsiders. Okay, don't sell any of your flour to outsiders until you have met the demand for division B. So it means that if you have to produce 20,000 units, and division B needs about 5,000 units. Okay, you first of all need to supply the 5,000 to division B, then you supply the remaining one to outsiders. But at what price would division A be transferring the 5,000 units to division B? That's what we call the transfer pricing. At what price should internal sales be made? That's what we call the transfer pricing. Okay, so we'll be looking at that one. How do you determine the transfer pricing? Okay, the transfer pricing, the determination is to some extent depends on whether the selling division has a spare capacity or the availability of what other suppliers and the price that they are quoting. So we'll be looking at that one. But the question that we are coming to solve is a combination of transfer pricing and issue about residual income. It's a pure application anyway. It's not a big deal, but you just have to be very okay with that particular one. So that is just an introduction about question number one for 20 marks, and they can ask you some theory stuff and also some calculation stuff. So somebody's going to be reading this question for us. We try it and see what will happen. If you have any question, then we ask after this one we address, then we move on. Thank you. And somebody should read question number one for us. I'm sure I've seen Nana, Auntie Nanaya. I'm sure I've seen you joining the meeting. All right, if Auntie Nanaya is not here, somebody should. Okay, she's still here, but maybe she's not at a place that she can read. But anyone can read, please. Anyone with a nice voice can read for us. Who is reading? Auntie Joyce, can you read? Oh, you cannot see my screen. Okay, let me check and see. Okay, sorry. You cannot see my screen, sorry. Oh, we can see now.
No, sir. Yeah.
Is it coming now?
Yeah.
Okay. Sorry about that one. So someone should read for us.
Question 1.
Okay.
Agile PLC has been operating as a beverage manufacturer for several years in Ghana. Its products are widely distributed in Ghana and other West African countries. The recent trend by the government to encourage and enforce sustainable practices among companies has compelled Agile to switch from using plastics to using biodegradable materials only. Agile operates two divisions, that is, Gagba and Muturu. Gagba is responsible for producing bottles that it supplies to Muturu. The bottling division of Agile, Gagba also sells the bottles it produces to external customers. The following guidelines underpin the operations of all the divisions of Agile. 1. Each division is at liberty to set transfer prices and also to choose its suppliers. 2. Agile uses residual income for assessing the performance of its divisions. 3. Agile's cost of capital had originally been pegged at 17.5% per annum. However, this is set to reduce by 25% because of favorable responses from stakeholders to the news of Agile switching from plastic to biodegradable bottles. Key operating data relating to the operations of Gagba and Muturu are as follows. Gagba division, maximum capacity 150 million bottles. External sales 110 million bottles. External selling price 238 Ghana cedis per set of 100 bottles. Variable cost 150 cedis per set of 100 bottles. Fixed cost 73,440,000 cedis. Capital employed 217,600 cedis. Target residual income 12,240,000 cedis. Muturu division. The Muturu division has found two other companies willing to supply biodegradable bottles as follows. 1. Kote PLC can supply a set of 100 bottles at 190 cedis. However, Muturu must make annual orders above 50 million bottles. 2. Nikwe PLC can supply a set of 100 bottles at 225 cedis for any quantity ordered by Muturu. Required. If Muturu provisionally requests a quotation for 60 million bottles from Gagba, A. Determine the transfer price per set of 100 bottles that Gagba should quote in order to meet its residual income target. B. Justify whether Muturu will accept the transfer price calculated in I above. C. Calculate the two prices that Gagba would have to quote to Muturu if it becomes the group's policy to quote transfer prices based on the opportunity cost. D. State two advantages each of return on investment and residual income as performance evaluation tools.
All right, thank you very much. Okay, so let's come here. Let's look at the first one. They say determine the transfer price per set of what 100 bottles that Gagba should quote in order to meet its residual income target. What is the residual income target? What is the residual income target for Gagba here? Is
12 million.
okay.
240,000.
Okay, 12,240,000, isn't it? Okay. How do we determine residual income?
Net profit.
Okay. Residual income is determined as what?
Net
Net
profit.
profit. Okay. Before interest and tax minus what?
Minus
Imputed what?
imputed cost.
Okay. And the imputed cost is the cost of capital multiplied by capital employed, isn't it? Okay.
Yes.
How do we determine net profit? How do you determine net profit? It's going to be net profit before interest and tax. Let's look at this, please. It's going to be the revenue minus what? Variable cost minus fixed cost. Okay, we don't have depreciation and all that stuff. Okay. Is this correct? Net profit is determined as revenue minus variable cost minus fixed cost. Is that correct? Net profit before interest and tax. Is that correct?
Yes,
Is
sir,
that
it's
together?
correct. Yes,
It's
sir, it's
correct.
correct.
Okay. Okay. What are the two sources of revenue for the Gagba division? Gagba division is going to be having two sources of revenue. Do you agree? Do you agree that Gagba division is going to be having two sources of revenue? Based on the question that we have, Gagba division is going to be having two sources of revenue. Let's go to the question back and you see this. Okay. Gagba division is going to be having two sources of revenue. What are the sources? We are going to be having the external sources and the internal sources. Do you agree?
Yes.
Okay. How many units is Motul division quoting? How many units are they demanding?
$60 million.
They are demanding 60 million, isn't it?
Yes.
Okay. But Gagba division can produce a total of how many units?
150 million.
150 million. So if we are supplying 60 million to, if we are supplying 60 million internally, okay, how many units will be sold to the external people?
90 million.
90 million. This 90 million will be sold at how much? You have to be very careful. Okay. They are saying that the external price is what? 238 per 100 bottles. It means that 238 is for 100 bottles. Not one bottle is 238. 238 is for what? 100 bottles. Do you agree?
Yes.
If
Yes.
238 is 100 bottles, then how much is one bottle?
2 to the 38%.
Okay, 2 to the 38%. So you can,
38.
I will show you two ways of doing this. So we have 238 divided by 100. That will give us 2.38 Ghana cedis. That is the price, external price per bottle. Okay, so we are selling 19 million to the external people. Do you agree?
Yeah.
And we are selling 60 million to what?
Internal.
To internally. How that is fine, isn't it?
Yes.
Okay. Now, 238. Okay. 238 is for 100 bottles. Another way of doing this is that, okay, if you are going to be using 238, that means that you have to now find the how many 100 bottles that you can have in 90 million. Okay, so let me come here and do this for you. I need to find my total revenue. Look at how I find the total revenue. I will do simple mathematics here. Okay, so I'll do my total revenue here. So look at how I'll do the total revenue. Okay, look at how I'll do the total revenue. So come here. I'll have the external revenue here. So I'll have the external revenue here. Look at how I'll do over here. I'll either do 90 million. I'll either do 90 million. Okay. So let me cancel this. I'll either do 90 million. Okay, let me do this. Let me do 90 million. Let me just do 90 million, normal 90 million. So I'll do 90 million multiplied by 2.38. Do you agree? I'll be selling 90 million bottles, but one bottle is 2.38 Ghana cedis, not 238, because 238 is for 100 bottles. Okay, or I'll also do like this. I'll come here, I will have 90,000. Or is it 90? Oh, that would be 900,000. 900,000 multiplied by 238. Think about it.
Okay.
Think about it. 100 bottles is 238. So if I have 90 million, it means I have to divide in 9. I have to take what? 2 zeros from the 90 million first. Okay, because 238 is 100 bottles. So it's just like 238 is equal to 100 bottles. Then how much will be equal to 90 million? Okay, that will give you 900,000 multiplied by 238. If you do it, you'll be getting the same answer. So let's choose any of them and move on. Which of them are we picking? Which of them are we picking?
First one.
Okay, what is the answer? $90 multiplied by 2.3. I'm having 214.3 million. Is that correct? Is that correct? Let's confirm that and move.
Yes.
Okay. So let's come to the internal now. You can see that we'll be selling 60 million. Do we know the price? Do you know the transfer price? Do you know the
No.
transfer price? No.
No.
So you have to let the transfer price to be any alphabet, either X, B, because they are asking now. They are not asking to determine the transfer price your own. So you have to forget about how you determine transfer price. The question is specific. What price should Gagba put to be able to achieve its target or residual income? So it means that what price should I sell the item? Should I sell the 60 million so that I can be able to achieve my 12,240,000 at the end of the day? So it means that I don't know my transfer price, but I know that if I have my net profit, which will be external sales, internal sales, I subtract my variable cost and I subtract my fixed cost from it, I'll be having my profit. And if I subtract the imputed cost from the profit, I'll be having my 12,240,000. So I have to look at how I do. Let me write it like mathematically, then we do it like normal figure here. So look at how I do this one now. I know that, look at this first. Look at this. Let me write this first before we go. Although I've written something like this. I know that my residual income will be look at this. I know that my residual income will be something like this. Look at this. Check this one. Let me move on. I know my residual income will be the total revenue. This total revenue will be the external revenue plus the internal revenue minus the total variable cost minus the total fixed cost minus the imputed cost. Total revenue minus the total variable cost minus the total fixed cost. That will give me the profit minus the imputed cost will give me my residual income. Do you agree? Look at this. My residual income will give me total revenue minus total fixed cost minus total variable cost. That will give me the profit before interest and tax. And if I subtracted my interest, imputed interest, which is the cost of capital on the capital employed, if I subtract it for the profit, I'll be getting my residual income. So I'll have this one. This is going to give me profit. Subtract my imputed cost, I'll have my residual income. So how do I determine the total revenue now? It will be the external revenue plus the internal revenue. I can determine my variable cost and fixed cost directly because I've been given that particular one. So I'll come here, I'll have 60 million X. So look at how we do this one. Total revenue will give us 214.2 plus 60 X. This will give me total revenue because I know that 214.2 is the external revenue. If I know my transfer price and I multiply by 60 million, I will get the internal revenue. Then if I subtract the variable cost, fixed cost from it, and I subtract my imputed cost, I should be able to get my target residual income. So let's come here and determine the variable cost and now do it like mathematics and move on. So let's come here. Let's come to variable cost. Okay. Variable cost will be very simple. Okay, variable cost will be very simple. Let's come. You can see that we are going to be producing all the 150 million. Do you agree? We are going to be producing all the 150 million bottles. Do you agree? Our production will be all the 150. Do you agree? We will produce 90 for external people, 60 for what? Internal. So in total, we are producing all the 150 million. So our variable cost would be the 150 million multiplied by what? Would that be 1.5 Ghana cedi? Variable cost. Would the variable cost be 150 million multiplied by 1.5? Please let's check that. We are together here. I'm not the only one here. Okay. So let's look at this one. Variable cost is 150 per set of 100 bottles. 150 per set of what? 100 bottles. So it means that variable cost per bottle is 1.5. Please, do you agree?
Yes.
Okay. Okay. So let's now move. If that is the correct, let's move on now to this one. Okay. So let's now have the what will be the total? 150 multiplied by 1.5, or you can do 1.5, because if you want to use the 150, then it means that you have to remove 2 zeros from the 1.5, 150 million. So you'll be having 1.5 million multiplied by 150. At the end of the day, you should be getting the same answer because it's going to be 150 million. But you are finding the cost for every 100. So you divide your total production by 100 and multiply by 150. You'll be getting the same answer. What are we having? 150 multiplied by 150 multiplied
225.
by 225, isn't it?
Yeah.
Okay. So variable cost will be 225 million. Okay. Are we giving our fixed cost straightforward? Are we giving our fixed cost straightforward? Let's check. Do you have the fixed cost? Fixed cost is how much? So that would be 73.44. Is that correct?
Yes.
Okay. Okay. So let's now find our profits. Okay. Let's now find our net profit before interest and tax. So you know that this net profit before interest and tax will be total revenue minus total cost. Do you agree?
Yes.
Okay, what will be our total cost? 225 plus 7344. What are we having? Let's write down
298.44. 8.44.
Okay. So you can see that our total revenue now is what? 214, isn't it? 214.2 plus 60x. Okay, minus what? 298.44. So let's come here, our net profit before interest and tax. So let's come here, what are we having? I'll be having net profit before interest and tax. Okay, check. You'll be having the 60x. Okay, minus what? What are we having? 298.44 minus 214.2. What are we having?
84.24.
Okay, so we have the 84.2 what?
4.
Okay, this is our net profit, isn't it?
Yes.
Okay, so let's find our residual income. We know that our residual income is equal to the net profit before interest and tax minus what? The imputed cost. Do you agree?
Yes.
Okay, and our imputed cost is the cost of capital multiplied by capital employed, isn't it?
Yes.
Okay, let's come in. Okay, let's come in. You have to be very careful here. Let's look at this. Okay. If you read the following guidelines and underpin the operations of, look at the third point. Agile cost of capital had originally been pegged at what 17.5% per annum. However, this is set to reduce by 25% because of the favorable response from stakeholders to the news of Agile switching from plastic to biodegradable bottles. They have said something over here that the government is trying to do something and the company is now trying to switch from what? Plastics to using what?
Biodegradable.
Are they going to be using the biodegradable or they will still be using the plastics?
We'll be using the biodegradable.
So will the cost of capital still be the original one?
No.
No. You see the target over here, the target residual income over here is the residual income that they are expecting from their operations. Now their operations will now be from using plastic to biodegradable. So if they are using the biodegradable, they are expecting their residual income to be this figure. So how do you determine the residual income? It is going to be the net profit minus the imputed cost, but the imputed cost will be the cost of capital for the new operations, not the old operation. So this is actually 17. This 17.5 is actually for using plastics. They will not be using plastics again. They will now be using biodegradable, and they say that the cost of capital will now reduce by 25%. So you have two ways of doing it. You can do your 17.5 and subtract what 25% of this figure from that particular one. Or if this is 100%, okay, if nothing has been done to this one, it means that we are using the full cost of capital, which is 100%, but it will reduce by 25%. It means that this will now be 70. The new cost of capital will be 75% of this. So you can also do 0.75 multiplied by 17.5. In both situations, what are we getting? What are we getting as the new cost of capital now?
13.125.
Okay, so we have 13.125. So let's now find our residual income. They have given us the residual income in the question. How much is it? Let's check that and see. It's 12.24 million, isn't it? We are doing everything in million, so our residual income will be 12.24 million. How that is fine? Okay. Is equal to our net profit is the 60x minus what? 84.24 million. Okay. Then we have minus the imputed cost. Imputed cost will now be 0.13. Okay, please, how much you using again? 13 point what?
13 points. 313.
So I'm having 13.125. Is it 13.125?
I'm having 13.31.
No, it's 13.125%.
Yeah,
It's not confirmed. Okay, so multiply by, let's determine the capital employed now. What is the capital employed that has been given to us here? And let's see. Capital employed is what? 217.6 million. Is that correct?
Yeah.
Okay, so let's come here. 217.6 million. Okay, please let's deal with this one now. Okay, find the 13.1 figure for me on the 2167. Let's get that one, then we now move on with whatever we want to do. 217.6. I'm having 28.56. Is that correct?
28.56.
Okay, so let's now deal with this situation now and move on. Okay, so I'll also show you another way of doing it. I will use the principle of break-even analysis and you see something. Okay, so let's come here and have this. So I'll come here. I'll have the residual income to be 0.4. Then I'll have my net profit, which is 60x minus, let's go there, minus 84.24. 84.24. Okay. Then I'll come there and have 84.24. Then I'll have minus what? 28.56. Is that correct? Okay. So I have imputed force is 28.56. So let's try something here. I'll have 12.24 plus 84.24, then plus 25.56 is equal to 60x. What are we doing? Let's do the other side. What are we having? 12.2. 12.24 plus 84.24 plus 28.56. I'm having 125.04.
Yes.
Okay.
Yes.
So 125.04 is equal to 60x. We divide through by what?
60.
60.
Okay. Our x is how much?
2.084.
2.08. Okay. This 2.08 is the what? Is the distance per bottle. But they're asking you to do for every what? Every 100, isn't it? Okay. So your transfer price will be, so look at this place. You have 2.084 multiplied by 100. Okay. Let's go to the question and check. They are asking you to do for every 100 bottles. Determine, so kindly. They say determine the transfer price per a set of 100 bottles that the entity should quote. But the figure that we have done over here is per bottle. It's per bottle. One bottle is 2.084, but we are looking for 100 bottles. So you multiply by 100. What is the transfer price? Transfer price to achieve the target residual income is how much? If you multiply by 100, is it 208.4?
Yes.
Okay. 20.4 per 100 what? Bottles. Okay. Let me also show you another way of doing this. Okay. Let's write this very simple. We know that our residual income is calculated as the net profit before interest and tax minus the imputed cost. But I can do my net profit as total revenue minus what? Minus total variable cost minus total fixed cost minus what? Imputed cost. So this over here gives me the net profit before interest and tax. And I subtract the imputed cost from it. I'll have my residual income. Okay, now I'll do my revenue like this. Look at this. I'll do my revenue like this. Okay. I'll do my revenue as I'll do the external revenue plus internal revenue. Okay. So the internal revenue, I'm selling 60 million bottles. But they are saying that at what price should I sell the 60 million bottles so that I can be able to get my target residual income? They are not asking me to determine the transfer price for them. They are asking how much you charge so that you can be able to achieve your targets. So how do you achieve your target? You know that achieving the target, you have your revenue, you subtract your cost, you subtract your imputed cost, then you get your target. So external revenue, you know it already. How much you charge for the 16 minutes so that you can be able to achieve? You know that if you have external revenue plus internal revenue minus the variable cost and then the fixed cost, you will be having what? You will be having the external what? You'll be having your target. But You don't know the price at which you are going to be selling to them internally. So you have to know the quantity multiply, assume the price to be any letter at all. Because you know that if you have the price, it will be 60 multiplied by that price plus external revenue minus the cost and minus the imputed cost will give you the target. So you just assume the price and do your calculations. So I'll come here and do total variable cost. Then I'll do minus total fixed cost, then minus the imputed cost. Doing this, I can directly do something like this. I can see my residual income plus the total fixed cost plus the imputed. Let me do something here. Plus the imputed cost will give me my total revenue, which is going to be my total revenue will be the external revenue plus the internal revenue minus the total variable cost. And you see that this will give you contribution. Revenue minus the variable cost will give you what? The contribution. Okay, so I'll come here straightforward. I have my residual income here. I know my residual income is actually 12.24. Okay, I know my total fixed cost. We have gotten that one already. What is the total fixed cost somewhere? What is it? Let's come here. Total fixed cost. I have 73.44. So I'll come here. I have 73.44 million. Then I have plus imputed cost. I've done that one already. So I have 28.56. Okay. Then you can come here and do your contribution. We have done that one already. So I will come here and have my total revenue is actually what? So I can do my total revenue is actually 214 points. Okay, let's do the contribution somewhere here. So I have my total revenue to be 214.2 plus 60 multiplied by x. This is the transfer price that we are looking for to achieve the target. Then I'll subtract my variable cost from it. So I'll have 225 here. Please, what are we having? 60 minus what? 60x minus what? 225 minus 214.2.
$10.8.
10.8.
8.
Okay. So I have 10. That will be negative 10.8, isn't it?
Yes.
Okay. So I have negative 10.8. But let's come here and deal with this particular one. So I'll group items now. Add this one for me. 12.24 plus 73.44 plus 28.56. What are you having?
114.24.
Okay, 114.24. You can see that I'll be bringing the 10.8 over here as positive. Do you agree?
Yes.
Okay. So if you add them now, I'm sure you'll be having a 125.04
Yes.
is equal to 60x. So you divide through by the 60 and you have that figure. Whatever answer that you're having over here is per bottle. Okay, I'll also show you how you can do your answer per the 100 bottles straightforward. Okay, how you can do it per 100 bottles straightforward. Okay, so by this one, whatever you are getting over here is per bottle. So I'll come here, I'll have my 2.084 per bottle. Okay, then you multiply by. So the transfer price, you just multiply by transfer price. So you just have the 2.0. Okay, so I'll just say 2.04. Okay, which will give me 2.084 multiplied by 100. So because they are asking me for that. So it's just application of mathematics. It's not anything. Okay, they just choose this particular question for you. This is what they ask them to do for 10 marks. Okay, so let's now do something here. Okay, justify whether Mochuru will accept the transfer price calculated in I above. Let's come here. How many bottles would the buying division be buying? How many bottles are they going to be buying? How many bottles is Mutu buying from Gagba? How many bottles?
60 million.
They will be buying 60 million, isn't it?
Yes.
Okay. They'll be buying 60 million. So let's come here. Let's come to, you can see that these people, they have two suppliers. The Mutu has two other suppliers, isn't it?
Yes.
Okay. The first supplier is saying that I'll be supplying you 100 bottles at 190, but you have to make sure that you order above what, 50 million, isn't it?
Yes.
Okay. Would the order be above 60 million? Would the order be
No.
above 50 million that they are saying? No. The one that we have, the quantity that Mochi will be buying from Gagba, they say assume that this one, the request is 60 million. Would the order be above the 50 million?
Yes, it has to be about 50 million.
Okay. It means that we are buying 60 million, which is above 50 million, isn't it?
Yes.
Okay. Which of these suppliers are they going to be buying from? Which of these suppliers will the buying division be buying from?
Kote.
We'll be buying from the first one, isn't it? Because we are buying more than what, 50 million. So our price will be what? They'll be charging us 190, isn't it? Okay.
Yes.
These people, they are saying that they will supply any quantity at all for 225. Okay, we only go to these people for supply when we are buying less than 50 million. Do you agree?
Yes.
Okay, because we cannot buy less than 50 million from the first one, the quarter, we cannot buy 50 million. But we are going to be buying more than 50 million. So we'll be going for these people to buy 190. So if you look at the two situations now, they have two other suppliers. Okay, and the quantity that Mochuru is what ordering is 60 million. Kote is saying that I will supply 100 bottles to you when you order more than 150 million. Since we are ordering 60 million, it means that we are going to buy the bottles from Kote at 190 per every bottle. We cannot buy from this one, Nikoi. We cannot buy from these people because they are saying that they will charge us 225 for any quantity that we are buying. But since we are buying more than 50 million, we go to these people and buy at 190. So the best option over here is to buy at 190. But these people, they are saying that they will charge us what? 208.4. Do you think the buying division will accept the transfer price of 208.4?
No.
No, they will not what? They will not accept it. Don't think about anything about sacrificing. The question is not telling you that assuming the transfer price is being set at opportunity cost. You can see that the external demand is one thing. We are sacrificing what? 2 million. We are sacrificing 2 million of this quantity to supply because the only quantity that we can supply internally is 40,000. It's 40 million. Okay, we can supply 40 million because we can produce 150. We will give 110 to external people, and we'll be having a spare capacity to produce 40 million. So we can give them 40 million. The question is not asking you to determine. What I'm trying to say is this one. Look at this. Calculate the two prices that Gagban will have to accept. Will have to quote to this one if it become the group's policy to quote transfer price based on opportunity cost. This is where whatever you are thinking about will come in. But this one, you just tell them based on what these people are quoting. Okay. If you have a supplier, the supplier wants to sell to you at 225, and your sister division wants to sell to you at 208. Despite everything, you will go for the 208 because if you don't get a 208, you go and buy a 225, which is higher than this particular price. But this one, you can see that you have two options over here. If they should be quoting 40 million, if they should be buying 40 million of the items, it means that we cannot enjoy the 190 from Coty because they are saying that we should buy above 50 million. So since it's 40 million, we cannot go to them. So it means that we buy the alternative supply will be what? Will be these people at 225. So if these people are charging 208.4, we will go for the 208.4 because the external supplier is quoting 225, but we are quoting 60 million. It means that this will be above the 15 million here. So we can buy for quoting, which will be giving us 190 million. So if we don't buy from you, we can buy from a third party at 190. So we cannot accept the 208 because a third party is willing to sell to us at 190 when we want to order more than 50 million and we are ordering 60 million. Okay, so they cannot accept the transfer price because there's a external source that is telling them that come and buy 100 bottles. Provided you are going to be buying more than 50 million, come and buy 100 bottles at 190. And they are quoting 60 million. So they cannot accept it because Corte Limited is telling them come and buy 190 when your order is above 50 million. But since they are quoting 60 million, it means that they can comfortably buy from Corte PLC at the 190. So the 208 will not accept it. Okay, they cannot accept this particular because there's an external source or there's an alternative source that can supply to them at a price lower. So they cannot accept. Okay, so justify whether these people. So you just see the transfer price is 208.4. However, there's an external source or there's an alternative supplier, which is Corte Limited, saying that I will supply 100 bottles at 190, provided your order is above 50 million. Since Mochuri is Corte 60 million, the order is above 50 million. So they can buy from Corte Limited at 190. Therefore, the 208, they cannot accept it. That is a very simple situation. Okay. Calculate the two prices that Gangbang would have to quote to Mochuri if it becomes the group policy to quote transfer prices based on opportunity cost. Over here, there's no condition. We are just going to be quoting a price. We don't want to achieve the residual income again. But what price should we quote when we are quoting based on what? Based on transfer, based on opportunity cost. Okay, we forget about the residual income. Okay, the question is not saying that quote the transfer price that they will be using to achieve the residual income. If that should be the case, then you should have the residual income in your mind. But this one, they are just asking if it becomes necessary for us to quote the transfer price based on opportunity cost, what would be the transfer price? Let's come here very simple. So if you are quoting based on transfer price, this is very, very simple. If it is going to be based on opportunity cost, it's a very simple situation. Let's come here. First of all, you have to determine the maximum capacity of the entity. Okay, you have to determine the maximum capacity of the entity. What is the maximum capacity of GABA? The selling division. What is their maximum capacity?
150 million.
150 million. Okay, how many quantities are they selling externally?
110 million.
Okay, so it means that we can be able to produce 110 and still have a capacity to produce additional units, isn't it?
Yes.
Okay, so you can see over here is that they are going to be having 150 million capacity, but they are producing 110 for external people. So you can see that if we produce the external people 110, you can see that our capacity, our production capacity will just be there. Do you agree?
Yeah.
It will just be there, which we can use to produce additional 40. Okay, you can see that whether we produce additional 40 or not, fixed cost will be incurred. Do you agree? It is the rent that we are paying for the facility. Whether you produce additional 40 or not, you will still pay the rent. If you decide to produce the 110, you will pay the rent. If you produce the 40, you still pay the same rent. So over here, we can produce 40. We can confidently produce 40 million for what? For internal purposes. So we have to produce 150, give 110 to external people, and give 40 to the Mochuru. Okay, if you come to Mochuru over here, we are only going to be charging them the avoidable cost. What do we call avoidable cost? Assuming we are not producing the 40, we will not buy material. Okay, we will not engage labor. Okay, we will not incur maybe variable overhead. The variable overhead can be the fuel that we are going to be buying for this one. But if we don't produce the 40, we will incur the fixed cost, if it's the rent. Even if we produce the 40, we still incur the fixed cost. So over here, we just set the transfer price for the 40 at what? At a marginal cost. What is the cost that can be avoided if we don't produce the 40? Or if you said, okay, the machine is there. Okay, I'm not going anywhere again. So the machine is there. You can take it and do whatever you want to do. What I will do is I'll go and buy fuel and other stuff. Okay, I'll buy raw material that I need. I will pay the workers and I'll buy fuel or something. That is the cost that I will incur because the people will still charge me the rent or whatever I will be charging. So over here, the first 40 million of the quantity can be produced using spare capacity. Therefore, the transfer price will be a marginal cost, which is the variable cost. So we come here and have the variable cost. So the first 40 million will be the variable cost. What is the variable cost? That will be 150 per 100 bottles. Okay. But you can see that these people are quoting what? They are demanding what? They are demanding 60 million. Where do we get additional 20 million? We can only produce 150 and give 110 to external people and give 40 to you. But you are demanding 20 million in excess. Where can we get a 20 million and give it to them? Where can we get a 20 million? It means that we have to cut down the what? We have to cut down the external demand by 20 million. Do you agree?
Yes.
Okay. So come here, first 40 million. First 40 million quantity. Okay, first 40 million quantity can be produced using spare capacity. Spare capacity, therefore the transfer price, the TP, the transfer price will be set at the opportunity at the marginal or at the marginal cost, okay, which is 150 per 100 bottles, okay, 150 per 100 bottles, okay. So come here. It means that if we want to give them additional 20 million, we have to now cut the external demand by 20 million. Okay. If we cut the external demand by 20 million, it means that you'll be giving 90 million to the external people and you'll be giving 60 million to us, to Muchuru. Do you agree? 40 out of this will be from a spare capacity and the 20 million out of this will be cutting down the external demand. Let's come here. What is the cost that we are incurring to produce? You can see that we asked them to refund the cost to us, isn't it? Which is 150, the marginal cost. In addition, if we don't sell to the external people, how much are we losing per 100 bottles? If we don't sell to the external people,
238.
no, we are going to be producing before we sell. So we sell 238 by incurring a cost of 150. So how much are we losing? $238 minus 150, what are you?
88.
That would be 88, isn't it? Okay. So the 20 million, we incur a cost of 150. They have to refund that cost to us. And we are also going to be losing 88 per every 100 bottles because we are not going to be selling these bottles to the external people. So if we sell the bottles to external people, they will pay us 150 for the cost incurred and they will pay us 88 million for what? As a profit. Okay, but we are not selling to them. So it means that we will not get a cost from them and we will not get the 88 too. So if you want to take the 20, you have to give us a cost incurred and the amount that we are losing from not selling to the external people. So you can see that the total cost will now be the 238. So if you are setting out opportunity cost, they will first of all refund the cost that you have incurred, which is the variable cost, plus any contribution that will be lost. So if we are not selling to external people, we are losing 88 per bottle. So if you want us to sell to you, you have to give us the cost that we have incurred plus the contribution that we are losing, which is opportunity cost. So the first 40 million will be at 150 per bottle, and the remaining 20 million will be at what? The external price, because we are cutting down the external sales. We should have given to external people 238. But since we want to buy, we are losing the 230. So you have to give us the 238. So the second 20 million bottles, 20 million bottles will be priced, okay, will be priced at what? At the external what? External price of 238. 238 per bottles. Okay. 238 per 100 bottles. 238 per 100 bottles. Okay. So if you are setting the transfer price at opportunity cost, these are the two prices that you will be quoting. First 40 million will be at the 150, and the remaining 20 million will be at what? Will be at the 238. Okay, you forget about whatever price that the outsiders are quoting. You are just setting your price based on the things that you are going to be losing. So you will not consider what the external people are saying. No, how much they want to give to them. You are saying that if you want to buy from me, I have to give you the first 40 million at 150. And I have to give you the additional 20 million at 238. It means I'm giving you this as opportunity cost. For the 40 million, I will not lose anything. You can see the 40 million, we are not sacrificing the external demand. We have given the 110 to the external people, and we still have 40 million. So we are not sacrificing anything. So you can give me the amount that I spent to produce that one. But if you want the additional 20 million, you have to give me the amount that I spent to produce it, plus the amount that I'm losing from selling to you. Okay, you have to give me that one. I don't care about what external people are saying. This is the price that I want to charge you. I don't care about what external prices external people are saying. So you forget about what external people are saying. Okay, if you want to consider the external people, then the question will not tell you that, assuming this is based on what? Based on opportunity cost. So if you want to sell to them and you are looking at the external people, you can say that, okay, if you want to buy any of your bottles, you can buy at 190 or you can buy at 225. Then I have to determine my price now. So I will look at this one. If the question is just telling you that you should actually quote the transfer price without telling that it should be based on opportunity cost or whatever, this is what I'll do. I'll come here and determine the transfer price per 100 bottles. I'll come here and do this. So I'll come here, the transfer price per the 100 bottles. I'll come here. The first 40 million is 150. So since it's 100 bottles, I'll have it's 14 million. So 40 million divided by 100, I'll have 400,000. Okay. So I have 400,000 bottles multiplied by 150. Okay. Then plus I'll be having 20 million, which is going to be 200,000 bottles, because I'm reducing it's per 100. So I'm taking 100 out of the figures. Okay. So I will have 200,000 multiplied by 238. So I'll come here and look at all the bottles. All the bottles will be 600,000, which is 60 million. So we'll divide all this by 600,000. Someone should give me the answer per 100 bottles. What is the transfer price per 100 bottles? Okay, for the 400,000, multiplied by 150. For the first 40 million, okay, it is going to be 60 million. Okay, so 60. I'll have 200 and multiplied by 238. That's 60. I'm having 107,600,000 divided by 600. Okay, I'm
Yeah.
having
179.3.
179.33.
okay, so I have 179.3 per 100 bottles. Okay, so if I want to know this one, so what I'll do is this one. So I will say that, okay, if I want to charge you a transfer price, okay, based on what I'll do, the first 40 million will be at 150. The second 20 million will be at 230. So if I charge you, I'm charging 179. Okay. That is the question is not asking you to do it on opportunities or you just determine what is the price that I'll charge you. It's 179.3. Then I'll consider the price that the other people are charging. Okay. I know very well that you'll be buying from. I know very well that you'll be buying from these people. You'll be buying from this because you are charging 600,000. So you'll be buying from these people. So you'll be paying 190 per bottle. So I'll come here and tell you that the minimum price that I can charge you, the minimum price that I can charge you per 100 bottles will be 179.3. Because I know that if you don't pay 179.3, the maximum that you will be willing to pay, the maximum price will be the 190. Because if I don't sell to you, you'll be buying from Kuti, which is 190. So I can charge you a price range. If the question should ask you for a price range, then it will be 179.3 to, or the minimum to be 1.73 and the maximum supposed to be 190. Okay, so if the question did not ask you to do it based on opportunity cost, what will happen? So the minimum price will be 179.3, and the maximum will be the price that you'll be paying to buy from the external people. But this one they say, what is the price that I can charge if it is based on opportunity cost? So I will not consider what external people are saying. I'll just if I want to sell to you, the first 40 million is for free, but the second 20 million I have to sacrifice. So I'll sell the 20 million to you at 238. So the first price will be the first 40. They say two prices. The first 40 is going to be 150, and the second 20 is going to be 238. Very, very simple. Nothing. So we'll state two advantages each of it. This one you can look for the answers in online. Anything. Let me show you something, then I'll take questions from you. And then we come here. Okay. Those of us that are okay. If you are on our MA page, please, I have some questions over here, which are particular questions, exam type questions. But unfortunately, we saw some of them, but we don't have answer for all of them. Let me show you where they pick that question from. What I'm trying to say is that you have to try the tutorial questions. Okay, so you can actually use AI to solve them. There's no issue about that one. So this is a question that they pick and they modify it. It's actually easy question. Okay. So they pick this one and they modify it to be that question one. So sometimes they pick these questions and modify it. The only thing that they do is that instead of them doing the prices per bit, they are doing it per 100 bottles. That is the only difference. If you look at this one, it is what? It is the same question that they just change the figures. Okay. Division C has found two other companies willing to supply. Look at this one. S could supply at 28 per bit, but only for annual demand orders in excess of 50,000. So you can see that it's 50,000. They have made it to 50 million. And Z could supply at 33 per bit for any quantity ordered. Okay. Division C provisionally requests a quotation for 60,000 bits. They made it 60 million from Division A for this one. Calculate the transfer price per bit that Division A should quote in order to meet its residual income target. The same thing. So they change the figures. Calculate Calculate the transfer price per bit that Division A should quote in order to meet, okay, that is the first one. Calculate the two prices Division A will have to quote to Division C. It becomes group policy to quote transfer price based on opportunity cost. Evaluate and discuss the impact of the group parents and propose policies on the profits of Division A and C and on group profits. Illustrate your answer with what? With calculations. That is it. Okay. So it's the same principle. What I'm trying to say is that we might be solving, you can use AI too. Although sometimes it will be correct, might not be correct, but you can just show that one. If you take your time to read, it's the same question. Okay. So you have to be okay. I'll be doing corporate reporting to maybe Saturday. Tomorrow I'll be going to check. So I'll do financial reporting. Question number one, I'll do it on Saturday, maybe FM2 on that the same day, and Sunday maybe I'll do public partnership and corporate reporting to question. Okay. So seniors, that is the idea about the whole thing over here. That those of us that we are new to this particular question, we will be doing the performance evaluation and the transfer pricing in details. Okay, we'll be doing that in details when we get there to performance evaluation. But those of us that we have an idea and we have sat for the exams, this is what they are asking you to do for 20 marks, and you can see there is not anything, but in the exam hall, you will be limited. You cannot think about this stuff within the
There's no time to think.
So that is the problem. There's not anything, but you
We
have
are
to
senior
solve more
below.
questions. You just have to solve more questions to be in a better position. If not, do you can choose and then. Okay, so I'll find time. I'll be doing one by one. So I'll do question number 2, which is about budgeting. Question number 3, which is about snack costing and other stuff. I will find time to do all of them. The question number 4, budgeting, and number 5, and then this is about maybe decision making and all that stuff. If there's any issue about this one, then we will address that one and the one. But if there are no issues, please have count.
Thank you.
All right. So if there are no issues, thank you very much. And I'll see you in one of our discussions. I'll do financial reporting on Saturday, and I'll share the link and I'll communicate with you. Yeah, Senior, you wanted to do something? All right. So please, if there are no issues, thank you for coming and enjoy your night and Saturday. God willing, we look at another stuff and Sunday too. And we are starting our class on Monday. And if you find interest in joining our class, fine, you can join. But whatever be the case, we are wishing you all the best in whatever you do. Thank you for coming and enjoy your night. All right, thank you.